Welcome to this Nedbank Financial Market educational series, proudly brought to you by our online share trading division. In this educational series, we will discuss various topics related to financial markets. Learning about trading and investing is essential for every client, as this will equip you to make more informed personal trading and investing decisions. As a client, you want to make money. However, there is more to these terms than meets the eye. In this session, we will discuss the topic of popular trading lingo. Such terminology is something every trader will need to understand. We're going to start with basic terms that most traders will already be familiar with. Then we will progress to more advanced terms in future sessions. Please note that this session is on both a beginner and an intermediate level. Before we start, we'd like to draw your attention to this very important disclaimer. In summary, you cannot regard this session as any trading or investment advice, as this presentation has been provided for educational purposes only. Let us commence this session. The first terminology we will cover is a bull market. A bull market is the condition of a financial market in which prices are rising or are expected to rise. The term bull market is most often used to refer to the equity market, but can be applied to anything that is traded, such as bonds, real estate, currency, and commodities. A bull thrusts upwards with its horns, hence the name for sharply rising prices. A bull market typically describes a condition in which share prices increase 20% or more from recent lows amidst widespread optimism and positive sentiment. Throughout this session, we will refer to shares, but the same principle will be applicable to other financial market instruments. Then what is a bear market? A bear market is when a market experiences prolonged price decline. It typically describes a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. A bear sweeps downwards with its claws, hence the name for sharply declining prices. Bear markets are often associated with declines in an overall market or index like the S&P 500, but individual shares can also be considered to be in a bear market if they experience a decline of 20% or more over a sustained period of time, typically 2 months or more. Bear markets may also accompany general economic downturns, such as a recession. While the terms are often used interchangeably, trading and investing are considerably different methods. Let us define trading. Trading is all about making frequent, short-term transactions with the goal of beating the market or generating greater returns than you would expect by buying and holding the positions over a longer time period. In the case of trading, short-term can range from immediate transactions, buying and selling a share within minutes, up to transactions that last days or weeks. The length of time between buying and selling shares is known as the holding period. A holding period is the period between the purchase and the sale of a share. Now let's define investing. Investing is a strategy geared towards managing and growing wealth in the markets over a longer period of time, that is typically years or even decades. This means buying shares with a long-term outlook in mind, holding them through both market ups and downs until you reach your financial goal or are near the end of your investment time horizon. Many individual investors invest in the equity market to save for retirement. You will likely contribute to this type of strategy when you are looking to generate returns over a lengthy time frame. The bid and ask price are essentially the best prices that a trader or investor is willing to buy and sell for. Let us consider what is a bid price. A bid price is a price for which someone is willing to buy something, whether it be shares, services, or contracts. It is colloquially known as a bid in many markets and jurisdictions. Generally, a bid is lower than an offered price or ask price, which is where people are instead willing to sell. Bids are made continuously by market makers in a share and may also be made in cases where a seller requests a price where they can sell. Sometimes a buyer will present a bid even if a seller is not actively looking to sell, in which case it is considered an unsolicited bid. The ask price, on the other hand, is the price the seller is willing to accept for a share, which is often referred to as the offer price. Along with the price, the ask quote might also stipulate the amount of shares available to be sold at the stated price. The bid is the price the buyer is willing to pay for the share, and the ask will always be higher than the bid. A spread can have several meanings in finance. Basically, however, they all refer to the difference between two prices, rates, or yields. In one of the most common definitions, the spread is the gap between the bid and the ask prices of a share. The more traders and investors that want to buy, the more bids there will be, while the more sellers would result in more offers or asks. The bid-ask spread can affect the price at which a purchase or sale is made, and thus affects an investor's overall portfolio return. The size of the spread and the price of the share are determined by supply and demand. The term volume in financial markets refers to the total number of shares that are traded in during a given period of time. Trading volume or volume is the amount of a share that changes hands over some period of time, often over the course of a day. For instance, share trading volume would refer to the number of shares traded between its daily open and close. Trading volume and changes to volume over the course of time are important inputs for technical traders. Another important term to understand is market volatility. Market volatility is a rate at which the price of a share increases or decreases over a given set of time. It is a concept that explains the level of uncertainty associated with the markets based on changes in the value of a share. High market volatility indicates that the price of shares can change dramatically over a short period of time. Low market volatility indicates that significant swings in the price of shares are less likely to occur, and that prices are more likely to remain relatively stable over time. Now that we know what trading volume and market volatility mean, the next concept it is important to understand is that of a thin market. A thin market, also known as a narrow market, refers to a market characterized by a minimal number of buyers and sellers, plus a high price volatility. A thin market is also characterized by high bid-ask spreads and low trading volumes. Due to the scarcity of trades available, this type of market experiences lots of drastic swings, thus making it difficult for traders and investors to trade systematically. As a result, it is quite common in a thin market for price fluctuations to be larger between transactions, and slippage can be a common occurrence. So what is a thick market? A thick market tends to have high trading volumes as a result of the large number of orders in play. The high number of buyers and sellers in the market mean it is more likely that buyers and sellers are able to find a satisfactory price and conduct trades. This means that thick markets tend to have higher trading volumes. Thick markets generally have low price volatility. More buyers and sellers generally means more people willing to trade at different prices, so price swings tend to be blunted by large order volumes at each new price level. Thick markets may feature large clusters of buyers and sellers around one or more price point, but in general they tend to feature a wide distribution of orders at different price levels. A thick market will also tend to have thinner bid-ask spreads, as more willing buyers and sellers will push the bid and ask prices towards each other. The more traders there are competing to execute trades, the more competitive it will be for both the bid and ask price, which means that the spread between them will be small in a thick market. Fundamental analysis evaluates shares by attempting to measure their intrinsic value. Technical analysis differs from fundamental analysis in that traders and investors attempt to identify opportunities by looking at statistical trends. Let us discuss fundamental analysis. Fundamental analysis, also known as FA, is a method of measuring a share's intrinsic value by examining related economic and financial factors. Fundamental analysts study anything that can affect the share's value, from macroeconomic factors such as the state of the economy and industry conditions to microeconomic factors like the effectiveness of the company's management. The end goal is to arrive at a number that an investor can compare with a share's current price to see whether the share is undervalued or overvalued. Our last common lingo in this session is technical analysis. Technical analysis, also known as TA, seeks to predict price movements by examining historical data, mainly price and volume. Many investors analyze shares based on their fundamentals, such as their revenue, valuation, or industry trends, but fundamental factors are not always reflected in the market price. Technical analysis helps traders and investors navigate the gap between intrinsic value and market price by leveraging techniques like statistical analysis and behavioral economics. It is not predicting the future or an endorsement or criticism of any company. It is a technique that attempts to find the probability of a future action of a company share. It is the movement of the company's share price, not the company itself, that is under scrutiny in technical analysis. Also, technical analysis does not give an absolute prediction about the price movement, but should be viewed as a tool to help the traders and investors anticipate what could likely happen to a share price so they can make a more informed trading decision. This educational video was brought to you by Nedbank Online Share Trading. We hope you found this session informative and useful. Any examples used in this session are purely for educational purposes. Thank you for your time.